has been, and the UK unemployment data that we're all obviously closely watching now. We had Carney speaking today. We did see the unemployment rate fall to 7.7 yesterday. How is it just a good headline number, or what's the data like beneath that?
Well, I think one of the things is, again, as you mentioned, Carney again spoke, again for the third time. He reiterated we're still looking at a 7% unemployment rate. We're talking mid-2016. Well, as you've seen, the overnight rate is implying mid-2015, okay? So they don't believe that. And as you just said, we had a much better than expected unemployment number. But also, I guess, I have a feeling as we've seen for the last 2 months in the U.S., we've seen, first it was 0.2, then it was 0.1, okay? But the thing is in the U.S. we have what we call the U6 number. That's the people in employment. And again, in the States, we had a dramatic fall in my age group, the OAPs, the pensioners, who got out of the system, okay? And the same thing that happened the last 2 months. Now, one thing we did see in yesterday's unemployment picture was the biggest sectional increase was real estate agents. It was a 10% increase in real estate agents, okay? And of course, then we saw the north-south divide in prices. So it's a question of, the thing we're going to have to look at is underemployment, part-time employment. I can't remember the name, but there are like 1 million people here that are sort of on contracts that sort of says,
0 hours.
yeah, 0 hours. You only get paid if you show up. Now, should those people be in the employment numbers? And as you see, in the U.S., the term is used as non-farm payrolls. Now, this is the oldest statistic in the U.S. It has been gathered since January of 1933. The reason why they said non-farm payrolls, because of seasonal farm workers, okay? So you have a distortion in California. You can't do too much picking of any this, that, or the other in Buffalo in January. So that's what they're trying to do. So you look through here, and the same concern I have is the demographics will show in the next 2 or 3 years, we will see a probably sizable decrease in old age pensioners leaving the sales force, leaving the unemployment.
And you touched on obviously the non-farm in the US there. We saw quite bad numbers last week, and probably quite unexpectedly poor numbers. This is obviously just ahead of the Fed meeting that we've got next week, which everyone is sort of anticipating the start of this tapering. Some revisions revised down slightly on how much they are going to taper. I just wanted to get your final prediction for Wednesday.
I'm a temper taper man. I think we will have the announcement. I think it will be 10 billion. I don't know whether it will be 10 billion all in treasuries or maybe 5 billion in treasuries and 5 billion in mortgage backs. Because one thing we did see in yesterday's mortgage data for the States, okay, 5-year low, okay? Because what we've seen ever since the Treasury 10-year went from 1.62 to 3% in May, we've had I think like a 3.30 to 4 3/4 mortgage rate. So you've got people with no inflation, okay, no pay rises, school fees now, maybe a new car, and all of a sudden looking to buy a house, and their mortgage is going to be, slightly more. So my feeling is that they will do it for 2 reasons. One, we all know they're going to do it, and 2, another thing. Remember, Bernanke's retires on the 31st of January 2014. So if they wait till October, if they wait till the December meeting, it's really unfair on the new incoming chairperson to all of a sudden sort of, catch the train while it's still running before it stops. So I do think they're probably temper tapering, and I think we'll probably get the announcement. But I also expect with the announcement a very dovish statement, okay? Because again, market implying, end of quantitative easing, tapering, interest rates going up. Well, it is. They aren't.
What do you think we could see from the markets then, alongside the Fed? What do you think?
Well, I think one of the things, I'm sure you saw it this morning, Goldman Sachs has come out, they're incredibly bullish on U.S. equities, okay? So I would expect, with a dovish statement, you'll start seeing buying, especially the 10 and 30-year treasuries. But that will also be dictated on whether they do decide to do anything in reference to reducing the mortgage-backed securities. Because if the Fed is concerned about mortgage rates going up, the easiest thing to do that is continue to buy mortgage-backed securities.
Also, on sort of America, we saw the Dow this week that had an alteration of some of the companies within it, removing Bank of America, and Hewlett, and then putting in Knight, and Goldman's. Do you see this as sort of changing the demographic of of the US companies and it
Now,
changed that?
I mean, for maybe some of our viewers that are over here, the Dow was only 30 companies. You know, it's just like, oh, look at the FTSE 100. 77 of the FTSE 100, more than 50% of their revenues are overseas. So, you know, HSBC is not the Herefordshire, Shropshire, Berkshire Bank, okay? And I think that's one of the things to look at. If you're looking at the S&P has a much better balance, okay? And I mean, for the simple fact is, years ago when I first started, okay, I was working at the Morgan Guaranty Trust Company. I think the Dow's been around since, like, say, 1903. It wasn't until 1972 that they had a bank, okay? When I started in 1971, 6 of the Dow components, 4 were railroads. 1 was U.S. Steel, and the other was a small departmental store called Woolworths. So, yes, I mean, if they were still on there, no, I don't, it's a question, it's like the FTSE, it's a basic revenues and stuff like that. And or as you said, you know, what are the hot ones? I mean, it took, I think it was probably 30 years before Microsoft decided to go, because Microsoft, you know, why should I pay S&P $500,000, million, you know, to give me a certain rating so I can go on the Dow? But I think if you're looking at how the U.S. economy is, I know, look at the Russell. That has the best balance of where the U.S. economy really is.
Moving on to some more Europe, we've seen a bit of chatter between the ECB officials about whether to release minutes of their meetings and how far they should how much detail these minutes should contain. Asmussen sort of arguing for very detailed, that we should get everyone's comments. If they're in that position to be voting, then they should justify what they're voting for, whereas Draghi is a bit more reserved and wants to maybe, you know, minutes, but not exactly who's voting for what. What do you think would be the best situation?
For people, we have first Klaus Liebscher and then Trichet, okay? No matter what was discussed, we decided. It's only, even Draghi has at least said, well, there were 3 or 4 dissenters. So at least he is sort of starting to get right with the program, okay, to prepare us. But you see, I don't think this will work for 2 reasons. One, with the Fed, okay? Remember, the Fed is 13 Federal Reserve districts. Now, the Federal Reserve sets the U.S. repo rate, but each Fed district will have what they call, you know, the discount rate. Okay, so if Cleveland needs to reduce the rate, they will. If San Francisco needs to raise the rate, they will, to try to cool the economy. So you can do local rates. Now, until the ECB has ECB bonds, okay, the simple fact is Italy is going to have to. It's called the Italian bond auction, the Spanish bond auction, the German auction. Okay, and until you give the ability for the local banks within the European Central Bank more of a weighting on how they can adjust that, you know, I don't think that has any meaning. I mean, you know, it can be a situation where we would know, you know, after the slight problem, we know Greece probably would like to have, would have always voted to keep rates lower.
Yeah.
Spain, Portugal, etc., especially several months ago when we were seeing all-time highs in the 10-year. So you can infer that we would have known it wasn't a unanimous decision. And I'm sure there's still banks in the ECB that say we think there should be another 25 basis points just in an easy refinancing rate reduction.
And lastly, we've got yields, sort of the 2-10 spread is in quite a few countries is approaching sort of 12-month highs, and particularly Germany and the UK really up at those high levels. Do you see that there's room for flatness here, or do you think this is sort of continuing the trend?
Well, I think one of the things, and maybe this is just my background, okay, in the US, and I've lived there for 25 years plus, mortgage rates, because when I lived there, say 85 to 90% of mortgage were fixed rates, okay, and they used the 10-year treasury as the benchmark to see where you would use your mortgage would be off that. They're even over here now with more fixed rates, they're still using the 10-year as much more, you know, of a benchmark. And so therefore, if you know, you're going to see the interest in the 10 years because you've got the short money market people. They will look at the 2s. You know, the investors will look at 10s and 30s. I mean, just a classic, just like yesterday with the Verizon. I mean, what is it, a 45 billion pound deal, but they had over $100 billion worth of interest in it. I mean, I think there were, you know, half a dozen issues. So I think that kind of spread, but you see, you also use that type of spread, okay? hence the reason the people that have been bearish on the euro were talking about the euro 2s to 10s and gilts 2s to 10s, that the euro should not be trading, especially euro sterling, now at 84 pence. Okay, there should have been a major differential there based on the 2-10 spread for the two different countries. So I mean, it's a situation where it makes it very difficult for some of our viewers, because some of the traditional spreads that people had traded off of or traded on now maybe get distorted because of what's happening, especially within the Eurozone. Okay? Because the simple fact, there's no ECB 2s, ECB 5s, ECB 10s, ECB 30s, and something like that. So hence the reason, especially in the States now, this is going to be key in reference to how the Fed makes their statement, next Wednesday evening, because it will have a dramatic impact, as we were talking earlier. I mean, in May, the 10-year was 162. Just last week, it traded over 3. That's one heck of a move, okay? And that's had a dramatic move, because what we're starting to see now is mortgage applications fell dramatically, as they will start to over here, okay? And not so much here in London, but people who have to buy houses and stuff like that, if rates stay high and the market really starts to believe we'll have an interest rate hike in mid-2015, then all of a sudden the gilt's going to go over 3% right now. And I mean, I know, one or two accounts out there now advising their clients, if the gilt stays at 3 or 3 plus, buy all you can in the 10 years, really not making any adjustments, because the short end of the curve is more the money market area. And as I say, I don't really follow that. I follow 10s and 30s because of where borrowing, especially in mortgage-related securities, has to do with the housing market globally.
Thanks very much for that. We'll see you next week.
Okay.